Past performance is no guarantee of future results. Content is offered for information purposes only. Unless stated otherwise, any and all individuals participating in the video are third parties that include both professional investors and individual investors who may not be licensed or certified by any institute or regulatory body. Unless stated otherwise, the views or opinions expressed may not reflect those of Seeking Alpha as a whole. The accuracy and completeness of content shared cannot be guaranteed. Seeking Alpha does not take account of your objectives or financial situation and does not offer any personalized investment advice. Seeking Alpha is not a licensed securities dealer, broker, U.S. investment advisor, or investment bank. Hey, I'm Daniel Snyder, and this is ETF Spotlight. Today, we're talking about real estate, and we're joined by the one, the only Brad Thomas. Many of you know him from running an investing group here on Seeking Alpha. That was IREIT, and now recently IREIT and Hoya Capital. We're diving into his ETF, the backing of it, the creation of it, the idea of it, and we want to ask him, is it meant for the investor like you? So without further ado, Brad, I want to welcome you on in here, and let's just dive right in. Real estate, 2025, we're getting macroeconomic data. What are you thinking about real estate in the year of 2025 now and going forward?
Sure. With real estate in general, certainly the last year or two have certainly not been terrific years for real estate and specifically, real estate investment trusts. However, as I like to say, you shouldn't paint all things by the same brush. And, there are certain property sectors that are going to perform better than others. And so that's what I'm excited to talk about here on this call and how the individual investor can really take advantage of some of these discounts that we're seeing out there. Because obviously shares haven't performed well last year, which means they're relatively cheap today. And I think there's definitely going to be some opportunities. I see a catalyst out there, and Daniel, that I think is going to make it the year 2025 to get back into REITs or stay in REITs if you aren't right now.
So that's a nice little teaser, and we're going to dive into that. But I think all investors are kind of wondering, okay, well, it must not be interest rates, because we've already seen the cut of interest rates a couple times now in 2024. And now we're seeing interest rate cuts get kind of pushed out further and further as more macroeconomic data is released. So if it's not interest rates, what's the catalyst that makes REITs the destination to be?
Well, I just wrote on Seeking Alpha today. So the title to the article is something like alert, recession alert. I believe all the signs are there, Daniel, that we are moving closer and closer into recession. Now, don't call me Doubting Thomas, because I know I said that probably in 22 and 23. And the Fed was able to soft land this. But I believe from what I'm seeing right now, I believe that it's very possible that President-elect Trump is going to step into a recession sometime this year. Is it the second quarter? Is it the third quarter? Is it the fourth quarter? I can't tell you that, but I do think we're moving closer and closer to that recession period. So what that tells me as an investor, keep some cash available. The last recession that I was a party of, the last big recession that I was a party of was the Great Recession. I wrote about that in the article today, and kind of some of the agony that I went through in 2008 and 2009. There was tremendous wealth that was created in that period for investors who were able to not follow the herd and to go against the general public here. So get ready. I believe a recession is coming, and I think that's going to be sparked by a lot of factors in the market that we're seeing right now.
Brad, those are strong words. I think you're fully aware, but there's a lot of new investors that have not experienced a recession. A lot of people were calling for a soft landing. They were calling for a recession. It hasn't come about yet. Why a recession now? And what should these newer investors in the market, and maybe even to REITs, what should they know about?
Well, I don't believe the employment numbers. I think the employment numbers are a lot worse than people indicate. I also think when I look at the consumers today and kind of what they're spending on, the credit card, accelerated credit card debt, the subprime car lending market, retailers still going bankrupt. There are more retailers to go bankrupt. I think you've got to be very selective in the marketplace, Daniel. And I know a lot of folks ask me a lot about retail, for example, in the shopping center space, and we can touch on that. That may be a good segue into some of these sectors. But retail is definitely a very volatile place. Now, I believe grocery stores are going to hang around, and one thing we're very bullish on is sectors within retail like grocery anchored shopping centers. That are anchored like for companies like Publix, for example, or H-E-B or Kroger. These are dominant grocery chains. So I think those are going to perform well, but we're also staying away from some of those other retail aspects that have really more dangerous traffic generators. And so I think, that's one area that I think we're very cautious in, kind of looking at the overall consumer, the health of the consumer. And I don't think that picture is really that healthy. And so I think that is this, as we continue to progress over the next quarter or two, I think we're going to see more pain in the retail market. Now, also, we talked about debt, and we covered a lot of there's definitely still a wave of debt maturities that are still coming down. These landlords, particularly in the private sector, are having to reprice their loans as they become due. I think that's going to also add more pressure. That could be, frankly, kind of that subprime, meltdown that we saw in housing, which really triggered, the Great Recession. It could be these loans that are maturing in these office buildings, these apartment buildings, as they have to reprice those assets. So I think distressed debt is going to be another thing that could really drive this thing into this recession. So I'm not predicting another, major drawn out Great Recession, but I do think we're going to have a mild garden style recession. And again, I think all those indicators are there. Also, interestingly enough, I'd love for you all to read the article, but I write about Homer Hoyt. Homer was a unique man who actually started out as an appraiser and a land economist. And he put together this study, and I call this the Homer Hoyt model. Actually, I wrote about it in my book, REITs for Dummies, and also in my previous book, The Intelligent REIT Investor. And if you look at this Homer Hoyt model, it's a real estate cycle model. Now, unlike the traditional stock market cycle, the real estate cycle is more predictable, and it's also a longer cycle because development takes time. Buildings take time. As a developer, I can tell you, it takes a long time to find a site and get the zoning and the permitting and actually get the buildings built and then leased up and stabilized. So that's a long process, and that makes the real estate cycle a lot more longer than the typical stock market cycle. But what Homer found out was over an 18-year period was kind of every 18 years is when these cycles would unfold and would move into this new cycle. And I think that's the cycle we're entering right now. If you read the article, you're going to see, I think we're going to be spot on with this. Another investor also used that same model going into 2008, and he was spot on with his Homer Hoyt model. So I think that's something that we're really looking at very closely. We're not market timers. I think fundamentals are the key. I'm not as interested today as interest rates are not as important to me as a real estate analyst as supply and demand. And so that's one of the main things we're seeing across a lot of these property sectors where you've got a lot of supply out there. And I think, we're seeing occupancies are going to continue to drop. And I think that's where we're going to really start having pressure in retail and certain other sectors. We're seeing some softness in self-storage. We've kind of leaned back from storage, given the amount of growth and the amount of supply that's out there. So again, reading the tea leaves in all of these property sectors, it's an indication to us and a signal to us that I think a recession is imminent.
All right, so let's dive a little bit deeper because you had mentioned you don't really care about the employment. Well, I just think care is the wrong word, but you don't really trust the employment numbers. And you're talking about a recession that might be coming. And we know that here in the United States, the economy is made up a lot of the consumption of consumers in the United States. So when it comes to this recession, are you seeing it kind of more targeting certain cohorts of the population, or is this going to be a full widespread recession? What do you think?
That's an interesting question. The big thing is we've got so much technology today, and with artificial intelligence, you just can't, I can't overly emphasize, the importance of artificial intelligence. Now, I don't think that's going to, ruin my job. I think a lot of investors really want to have their analysts go in and meet with these managers and do a lot of this subjective research, which is what we do here. But I will say, I think the signals are very strong to me that I think the recession that I'm talking about is going to hit across all sectors. Now, technology, again, I'm going to take that to a side because I think you've seen exponential growth there in that sector. But I think overall, it's definitely going to be impactful. And I think that the latest news, of course, being these fires in California. I mean, what is that going to do for inflation? Just think about all the money now that's going to have to be going into that market and rebuilding and all the construction. And this economy is so strong in California, that could be the tipping point for the recession as we have now, I believe, more increased inflation. So it's going to be tough. And, I feel for all the people in California. And by the way, I'm in, South Carolina. I mean, we're still reeling from the Hurricane Helene and the impacts that we saw with this storm. So I definitely think inflation is going to really continue. And again, I think these California fires, we really need to be studying that really hard to see what are those impacts going to be going forward to our economy.
Yeah, well said. Our thoughts and prayers definitely go out to everyone affected. Brad, going into the investor's mentality, though, we know that there's opportunities within all sectors to find areas for returns throughout 2025. So maybe we can dive into some of the sectors, maybe some of the industries within the REIT space that you're favoring right now.
And let's touch on some areas that I'm avoiding. Again, thinking about it from a recession perspective, I'm avoiding lodging. For the large part, I think lodging has always underperformed in a recessionary environment. Especially the higher, the Hilton and Marriott brands. A limited service typically perform better. Again, because they're less expensive and corporations are moving down to a lower end, travel product. But I think I would avoid hotels. I would avoid timber is another sector I'm a little bit nervous about, as well as office. We're continuing to really be strategic. I think there are some good opportunities in office, but again, you still very much know the situation with work from home. Now it's going to be interesting to see what Elon Musk and Doge does with their proposal to bring those government employees back into work. I just wrote about that I think it was last week on Seeking Alpha. But in terms of those sectors I'm avoiding, I would say hotels, timber, office. Billboards is another one, very much exposed to retail. And again, select retail. I'm not saying every retail, but I prefer kind of these necessity retail landlords like the grocery anchor centers. Now, where we're most bullish and where I think you should be most defensive in this phase right now we're in right now, I mentioned to you data centers and the insatiable demand in artificial intelligence. Digital Realty has been a terrific holding. Equinix, as well as Iron Mountain, who has a certain number of data center properties. American Tower also has gotten into the data center space. And again, we think cell towers is another very interesting, compelling sector right now too. We like the predictability of the income with those two property sectors. Also kind of moving down the curve, but I like healthcare a lot. Certain sectors of healthcare, especially the senior housing, the silver tsunami, that population is certainly the driving force of the catalyst for that part of the healthcare space. So again, I'm still very bullish in healthcare. Net lease, definitely bullish. Now, some may argue that net lease has sold off significantly. Most of you know that I write on Realty Income about every other day, maybe not every other day, but you have a lot of good names in net lease right now. Realty Income being one of those, Agree Realty being another one, and Beachy Properties, BIC being the gaming REIT being another one. So I really think net lease, that the opportunity for net lease is really not talked about enough, and that is the consolidation. How these companies, especially these dominant franchises like Realty Income or Agree or a Beachy, and throw in NNN REIT as well, NNN, they can continue to consolidate and grow their portfolios. I think one of the great things about the net lease space today is you're going to see more sell leaseback transactions that are conducted with corporations because those financing costs are still relatively high for those corporations, and being able to unlock that real estate is tremendously helpful for those companies. So being the landlord, say, to those businesses like Realty Income, I think there's tremendous opportunity to continue to consolidate this very fragmented marketplace of freestanding properties. So I definitely am still very bullish about that space. And by the way, even though costs have increased, debt costs have increased for companies like Realty Income, they have been able to maintain their investment spreads or their profit margins, which of course means very reliable dividend growers. And those net lease REITs, by the way, in the Great Recession, they were able to continue to grow their dividends. NNN, Realty Income. Now, WP Carey did as well. We all know WP Carey cut their dividend as a result of the office spin, and they had to reset that, obviously, for their new WP Carey 2.0 business model. So I like that. I like that area too. I'm trying to think. The industrial, I'm more neutral on that. I think there's definitely going to be opportunities with industrial. I think in terms of what President Trump is planning to do with his administration, in terms of bringing jobs into our country, into the USA, I think that's going to create more demand. Tariffs, though, could have an effect to the industrial space. So we're waiting to kind of see where that happens. Again, I'm more neutral on that. As things progress, we may become more bullish with industrial. But right now, I do think that's definitely a sector that deserves allocation. I just would not go overweight in that space. I think I've covered most of the major ones. Apartments. Last one I get residential. You got apartments. You have manufactured housing, and of course single family residential. I'm extremely bullish with apartments. I think people are always going to need a roof, just like they need groceries at these grocery anchor centers. And I'm most bullish in Sunbelt. I live in the South, in South Carolina, and it's a great market, great economy here. Florida, Texas. So owning companies like Mid-America, ticker MAA, or Camden Properties, ticker CPT, those are where we're really focused on the most as well. So anyway, but that's kind of an overview. I do think we got earnings getting ready to come back up here. So we're all gearing up for fourth quarter earnings. I think we're going to have a relatively normal fourth quarter earnings period. It'll be interesting to see what these companies are guiding for 2025 and kind of what impact they see with regards to Trump and the administration.
Yeah, there's a lot on the line. Now, Brad, I'd like to go ahead and pivot because we need to talk about, you talked about dividends. We're talking about REITs. So obviously people are caring about those monthly dividends. And you recently created the ETF IRET, that is the IREIT Market Vector Quality REIT Index ETF. I want to kind of bring awareness to people watching this, that this ETF tracks an index that was created by you and your colleagues. Just kind of curious, when that index was being put together, what kind of fundamentals were you kind of most gearing toward getting to that index and then having the ETF track it?
Well, yes, and you said it correctly. I will say my disclosure from a regulatory perspective, I don't manage the ETF. My partners and I, which is Market Vector, we built and created the index, which basically the ETF mimics that index. And so, but yeah, we've been thinking about this strategy for a while. There's a pretty big playing field of products. In my REIT for Dummies book I just published last year, I have a whole chapter, in fact, dedicated to REIT ETFs. So in the U.S., pretty sizable number of REITs. There's approximately $100 billion, actually a little more than that, of assets under management in the domestic world, not the international. And of course, most are familiar with the bigger market cap weighted names that they get a lot of love, like D&Q, which is dominant. They've got about 70 billion, almost 70% roughly of the market cap weighting in the REIT ETF world is D&Q. And you have a number of larger, also market cap weighted, ETFs. You have SCHH and XLRE and IYR and ICF. Those are all market cap weighted. And if you go through and look at constituents for all of those in the top 10, most of them are going to have the same players throughout the top 10 list. Prologis, American Tower. These are just big market cap companies. But here's the differentiator. We saw this is that you have these diversified ETFs. But we all know what diversification means. You can have so much diversity. I think John Bogle's the one who created this concept of diversification. So we said, you know what? There has to be a better mousetrap. So the strategy that we built is a diversified strategy that includes, all of the property sectors you would have, in the REIT ETF landscape, but a more strategic model that screens for using fundamentals, screens for quality and value. So to our knowledge, there's no other index that has this type of strategy aimed to really be more of a sharpshooter, if you will, for fundamentals within those sectors. And the other thing we saw was in terms of, we didn't want to have like an equal weight. We wanted a strategy. So again, what we decided to do was kind of create more of a weighting strategy where we could take the analyst consensus estimates for those constituents. We have what's called the IRET 100, which think of it as the highest quality U.S. equity REITs. They're all pretty large names. Again, there's about 150, 160 total equity REITs, but we basically pull from about 100 of those companies. And from that list, the index screens for 40 based upon quality and value. And again, those are somewhat weighted by based on their consensus numbers, which we also provide kind of the sector average. So case in point, this index doesn't have a tremendous amount of office exposure because if you look at consensus numbers for office for 25 and 26, they're not that good. They're very modest. And so there's an underweight allocation to that. So we try to create a strategic index, again, differentiated. We wanted to have diversification, but not diversification. In other words, we wanted to have, kind of the good and great, not the good, the bad, and the ugly. And that's exactly what you get with these bigger market cap weighted, ETFs. It's just everything. So I think we're very strategic. There are other, we call them specialty indexes that may focus on different property sectors like server or Indus or I forget, there's a couple others out there that are more, specialty oriented. But this strategy, again, it is unique to the peer group. And so that's what we built.
Amazing. So I want to, before we have to jump off here, one more question for you. For investors that may not know about what to look for in a REIT ETF, or what they should be looking at, pros and cons versus where that is coming from the man who wrote the Investing for Dummy and REITs book last year, what might you be able to share with investors that are just jumping into the space going, I really want to invest in ETFs, but I'm looking through all these REIT ETFs, there's direct ownership, there's none, and like, what would you tell them today?
Sure. Well, I mean, there's a lot of things you have to look at accordingly. And again, expense fees are important to look at. It's also important to look at dividend yield, distributions. Again, we looked at all of those factors. And again, the final decision makers was our asset manager, which is Tidal. But this ETF does pay monthly dividends. So we know that's something that a lot of investors are interested in. I saw that firsthand when I first covered Realty Income, the monthly dividend company, and a lot of retail investors really gravitate to having monthly dividends, having a higher yield. One thing we did with our strategy with IRET is the index is we also have preferreds. I should have mentioned that. We have mostly equity REITs, but we also have a small slice of preferreds. Again, kind of more of a yield enhancer, which gets our yield up. So I think investors always look at the yield. They look at the distribution. They look at the expense fees, and obviously just compare and contrast with how many constituents, what are the top 10 look like, how much exposure to the top 10. All those things are important. But I mean, at the end of the day, ETFs are great because it really gives the individual investor access to REITs. There's a lot of folks who just don't have time to go out and build their own portfolio. They're more do it for you. They want somebody to do it for you versus do it yourself. A lot of the people seeking out for DIY, do-it-yourself investors, they read my articles or Rita's articles or many articles on the Seeking Alpha platform, and then they look at the tools they have with Seeking Alpha, and they decide, how to build their portfolio utilizing this do-it-yourself website. But there are a lot of folks who just don't have either the time, the money, the expertise. So ETFs are certainly a great solution. And obviously, we cover a lot of ETFs in our research here at Wide Moat Research. And we think that's certainly a sector that's continuing to grow, and that investors are interested in and saying, this is our first strategy. We're looking forward to launching other index strategies in the future.
I'm looking forward to it as well. Brad, it is always a pleasure to have some moment to talk to you. I mean, I know it happens only every few months. So here in a few months when we talk again, I hopefully we're not in the depths of a recession, but we greatly appreciate your insights, and everyone want to highly encourage you, go check out IRET. IRET is the ticker for the ETF that we're talking about here today. Brad, give you a quick moment. Do you want to say anything to anyone watching right now?
Appreciate the opportunity. I want to thank you and Seeking Alpha. Wish everybody the best for a new year. I think it's going to be a really good one.
All right. Take care. We'll see you in the next episode.